Hello, Sector Watchers. Welcome to the show. This is and can we get a drum roll now and fireworks and everything, the 200th episode of Sector Spotlight. Can you believe it? I couldn't when I came up to this show. I actually had to look back. It's about 4 years ago that we did the first version of Sector Spotlight on the 1st of October 2019. And what a ride it has been, and we're still going strong. I love doing it. I love all the comments that are coming in. And if we look at the viewership, I think we're very happy to have you with us. My name is Julius de Kempenaer, and I am presenting to you this time from the StockCharts office in Redmond, Washington. Today's show, I told you, I promised you, is going to be special, and I have a very special, at least to me, guest remotely with us, and that is Sam Stovall. I will introduce him later on, but many of you will be aware of his work, and we're going to have a kind of a freewheeling chat about sector rotation and all the work that he's been doing in that area, and how we met, and I think it's going to be good fun. Before we do that, let me start with a quick overview of current market rotations. I always like to start with a look at the asset class rotations, and I've narrowed it down here to the SPY, to stocks, and the fixed income related ETFs, asset classes. And what we can see is that the rotation of SPY, of stocks, is actually on a right trajectory. We're inside the weakening quadrant, but rotating back up to leading. And as you know, when we go from leading to weakening and then back up to leading, that's usually a very strong rotation because it means that we're starting a second or third leg in an already established relative uptrend. So that's a good thing for the stock market. If you look at the opposite side, we find government bonds inside improving and already moving down. So they are really on an opposite trajectory compared to stocks. We've got high yield inside leading, but rotating down, so they're also on a negative heading. And the only odd one out there is corporate bonds, LQD, which is inside improving and still moving to the right. In general, de facto, I think it still means that stocks are on a trajectory to outperform bonds at the moment. The chart that I like to bring into that is the comparison of SPY and IEF. And if you look at that, we had that consolidation that took a couple of months, and then we broke out to the upside, and we're still holding that break, and that's a good thing. So that's another, it's basically what you see here, but it also underscores the strength of the stock market right now. Despite what a lot of negative people might be able to tell you, I think the evidence is otherwise. Stock market is still outperforming bonds. And when we start talking with Sam later on, we'll have a chat about that yield curve stuff and what's happening in the bond market, because that's a pretty crucial effect of what's happening in stocks. If we quickly move to the sectors, then here's the sector ETF RRG, and the one tail that really catches the eye is the one for energy. Look at that big red tail that moving from leading all the way through weakening, and it's now just about to cross into the lagging quadrant. It's underscoring the current weakness or the building weakness in the energy sector, in the energy stocks, and the RRG shows that beautifully. We also see communication services making a similar trajectory, but with a way shorter tail. And what that tells me is that this move is not as strong as the one in energy. We've got technology moving right up into the leading quadrant. Everybody's talking about technology, so I'm not going to do that. What I really do like is the financial sector. You can see how that is starting to move into the leading quadrant. And we look at the chart in a minute, that looks really strong. And if we look at the healthcare, and I need to highlight it for you to make it stand out, you can see how the healthcare sector is actually making a negative rotation. We went from lagging into improving, and it looked pretty good, and now it's rolling back down, basically sending a negative signal, underperformance for the healthcare sector. And as you know, healthcare is one of the defensive sectors together with staples and utilities. And the weird thing, or confusing, is that when you look at utilities and staples, and that's utilities and staples right here, they are still inside improving on a pretty good trajectory. The only problem is they are the lowest readings on the RS ratio scale, and that makes them the lowest or the weakest two sectors in the universe. And if the rotation of healthcare has any forecasting value for defensive sectors as a group, I wouldn't be surprised if we would see utilities and staples following that trajectory of the healthcare sector in the next couple of weeks, meaning that they will start to roll over inside the improving quadrant and head back down to lagging. And then we've got one of these situations that we talked about before on the show, where money is rotating out of the defensive sectors, and generally that is a good thing for the market as a whole, which then again ties in with the rotation that we saw in the asset class RRG, where stocks are starting to pick up strength. Now, the sectors that I think are probably worth a look from a positive perspective are real estate, because that is really accelerating, and as I already said, the financial sector. Let me give you a few of these charts really quickly. So let's start with energy. That's that big tail that's moving into the lagging quadrant. And what you see here is the RRG lines rolling over, crossing below the 100 level. That's causing that crossover. But what I like to see when I look at these relative strength things, I like to see confirmation on the price chart. And I am totally aware of the fact that trend lines are very subjective. I try to draw mine as good as possible, basically living to the rule that the more touch points there are, the more reliable the line is. And you will never see me draw a trend line touching only 2 points, because I think they're useless. And this one is kind of valuable because it's what 1, 2, 3, 4, 5, depending on how you count, 6, and we're now breaking that rising support line. So that is an added negative connotation for the energy sector, underscoring the relative weakness. We go to healthcare. That's the rotation that we just talked about. There is a different thing going on. You can see how that relative strength line is really bad. We're actually starting a new leg down in this already existing relative downtrend. On the price chart, not so much. We just crawled back above that rising support line, but there is a lot of overhead resistance. We're going to have to see how that pans out in reality in the next couple of weeks, but based on the relative strength, I think that healthcare maybe will rise in price, because that's the whole thing with relative strength. It can go up in price, but still underperform the market. And healthcare could be a very good sector to show such a behavior. If we look at utilities, then that is a much clearer picture, one of the defensive sectors. Look at that price chart. We're running up against that former support level, now acting as resistance. All the highs are lower, and relative strength is doing its thing, going lower, and that helps me to believe that that tail is ready to roll over anytime soon. And then finally switch it off with the defensive sectors. Here is staples. Look at that relative strength line. That's trying to break to new lows. It's at a super low level from a relative point of view. And this rally here is running into resistance. I don't think we can expect a lot of upside potential for the staples sector in the near future. So where can we see money rotating into? It'll be the financial sector, as I just explained to you. And we have that rotation going into the leading quadrant. But look at the price chart, where we are slowly but surely taking out each successive overhead resistance level. They're all horizontal levels, and we're getting to the more important ones. And as soon as we take out that early 2023 high, I think that we can see an acceleration in the financial sector. I did some work on the groups, and I think that it's really banks, asset managers, investment services, those type of groups where you should look for individual stocks, not so much in the insurance sector, in the insurance groups. And then we go to the real estate sector. That did a very nice run up, very rapid rally, and you can see how it took out some potential resistance levels. And it looks as if we're kind of trying to form a bottom in terms of relative strength. It's in the very early stages, if you ask me. There is still some work to do, but it's looking good, and you can see how the tail is accelerating inside the improving quadrant. So I'm definitely going to keep an eye on the real estate sector in the next couple of weeks. I'm going to leave it at this for the market update and the current rotations, and I'm going to introduce my guest for today's show, Sam Stovall. Hi Sam, it's so nice to have you with us today.
Hey Julius, thank you for inviting me. I'm happy to be on a show I frequently watch.
That is great to hear, and I'm so glad that you agreed to be on my show, because you do know that you are one of the, I highlight you every now and then, basically every quarter when I do my sector rotation model. By the way, I need to introduce you because I know you very well, and I know that a lot of professionals in the investment world know who Sam Stovall is. You're kind of a legend on Wall Street, if you ask me. But maybe our audience does not really know you. So, ladies and gentlemen, I met Sam. I think it was 2012, 2013, just after RRGs were introduced on the Bloomberg terminal. Sam was introduced to me through the CMTA organization, and Sam at that time was working for S&P's equity research department. And I think he's done that for like a gazillion years until that part of S&P was acquired by CFRA Research, where Sam is now the chief investment strategist. And again, as I said, the guy's a legend on Wall Street. Everybody knows him. Everybody who talks about sector rotation knows about Sam Stovall. So once again, thank you for having me. And was that quite of an accurate description of your career? It was very short. It's only 2 companies as far as I know.
That's right. Well, I don't know if you can see me blush, but I appreciate the intro. I've had good teachers in my life. I do read a lot. I do follow people. I'm a technician in a sense by admission, even though I work for a fundamental firm. And I've also had training from my father. My father worked on Wall Street, was on Wall Street Week with Louis Rukeyser, so followed in some pretty famous footsteps.
So you got some great heritage there. So Sam, as I said, we discussed the work that you did, and maybe you should tell these, because this is a funny story. You should tell these people how we actually met for the first time. What happened there?
Well, we bumped into each other on the street, interestingly enough. You had mentioned that you read my book, and we were talking about what makes the sectors rotate during an economic cycle. And I think I had mentioned to you 2 things. First off, in a sense, why are consumer staples and healthcare defensive? And I say it's the old adage that when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. And then the old telecom works well during the declining periods because students can't afford to fly home during the spring break. So what they do is they're on the phone a lot to their parents.
Yeah, I love that down-to-earth, like rationale or explanation why sector rotation works, why it is actually a thing. Because you probably have had your fair share of people saying like, it's a random walk, it doesn't work, markets are going wherever they want. But if you study history, you can see those patterns repeating and over again. And that's how you started thinking about sector rotation. And it's a good thing to see that even though you're on the more fundamental side of things, you can look at the momentum and what's actually happening in this rotational sequence of things. And you've written that book, the S&P Guide to Sector Rotation. I'm not sure whether that's the very correct title, but it's somewhere along those lines. And we have on the website of StockCharts, and I'm going to bring it right up for the people, is if you go to the perf chart and you look for the predefined group of sector ETFs. Below that is the sector rotation model that Sam is the author, the father of, and he described that in S&P's Guide to Sector Rotation. And I use that pretty much every quarter as a guideline to see, hey, where are we according to the theory? And I focus a lot on because tell me whether you agree or not, Sam. I think that when people talk about sector rotation, a lot of people are only focusing on the sectors. They're only focusing what's on the banner across the top of those sine waves. What I've learned is that the 4 macroeconomic variables that you've put down below are equally important, maybe even more driving that sector rotation than the market cycle. So I always start with 4 charts, which I have in a public chart list, so the users of StockCharts can grab that chart list and make my analysis, my assessment of where are we based on those 4 economic indicators in that cycle. And then from there, I go to the sectors and see whether they align. And what it gives me is a theoretical framework, and then I can look at what the market is actually doing. And my statement, my rationale is, if I see sectors that are rotating as in sync, aligned with what the model is telling me, then I've got something that's probably valuable. And if it doesn't, then it's like, all right, it's not happening.
Well, you're bringing up a good point. First off, yes, I do work or have worked for a fundamental research firm for quite some time. S&P was 28 years. I've been with CFRA for good into my 8th year now. But I can honestly say that while fundamentals tell you what, technicals tell you when and how far. Also, I'm a big believer in historical precedent. Mark Twain said that history might not repeat, but it frequently rhymes. So I will look to history as a guide. It's obviously never gospel. There was a famous saying that the stock market has anticipated 10 of the last 6 recessions. And so investors are anticipators. And you can get a feel for what they are anticipating based on what the sector rotation happens to be, also possibly looking at some of the sub-industries within those sectors. But Julius, as you had mentioned, there are specific macros that are drivers. And I would tend to say that it's the interest rate direction that is probably one of the more important macro drivers as to the kind of sector rotation we're likely to be experiencing.
Yeah, that's right. And when we spoke yesterday, you sent me a very recent report that you wrote, and I think that has a few very interesting paragraphs, topics in it that are very much up my alley when it comes to seasonality and sector rotation. So I'd like to ask you to sort of give you the highlights. And ladies and gentlemen, this is Sam's Outlook 2024 that he's written for C4A Research that goes to their clients. I'm not sure whether it's a public document, Sam, or is it just for your clients? Otherwise, we'd be happy to share it with our viewers if that's okay with you. We can talk about that later, and we'll put the description in the show comments if that's okay. But I can bring up a few of the tables, and I think those are the ones that are the most telling, and you can give your kind of view around those tables.
Sure. Well, if you take a look at the first one, which just shows price performances year to date through December 8th, a lot of investors are surprised by the strength of the market. We were up 19.9%. 2/3 of the industry, the sectors were in positive territory. But history told us early on this was going to be a very good year because we had a down year that was followed by an up January. The January barometer said, look for a good year. And we had a first quarter low that did not exceed the prior December low. In the 10 times that happened since World War II, the market was up 100% of the time, and the average gain was 25%. So history pretty much hinted to us that this could end up being a pretty strong year. I would then go to the third slide, which talks about the seasonal rotation, because here what it shows is as the Stock Traders Almanac calls, the best 6 months of the year, that's November through April, but then the old adage, sell in May and go away. This is a rotational phenomena that has worked, whether you look at large cap stocks since World War II, equal weight or mid cap stocks since 1990, the S&P small cap index since 1995, also global stocks, as well as breaking it apart into developed and emerging markets, where you have a pronounced strength in that November through April period, not only in average price change, but also frequency of advance, a batting average, if you will. But May through October tends to be fairly weak, and we have a very frequent situation where the November through April period beats the May through October period. And we are obviously in that favorable November through April period right now. If you go to the next slide, which talks about the presidential cycle.
Yeah, let me just jump in here real quickly, because you mentioned the almanac, the stock market almanac. At StockCharts, we actually have the almanac on sale, so you can still order it through the website. Go to the website, go to the store. It's a super valuable book. I mean, if guys like Sam Stovall use that in their work, I guess it means something. So we all love that stuff. It's done by Jeff Hirsch, great guy. There's a lot of work there. So if you're interested in that kind of work, he updates it every year. It's super valuable stuff. Sorry about that, Sam. It was a little plug.
Yeah, like I say, I learn from everybody. I've enjoyed my learning relationship from Yale Hirsch, the father of Jeff Hirsch, the current publisher, and I've shared with them things that I have done. And, so it's a good sharing relationship. But also what we're showing right now is investors historically have something to look forward to in that the fourth quarter of the pre-election year has risen 100% of the time for first-term administrations, with the average total return being about 6%. Obviously, we're doing better than that so far this time around. But next year, we also have something to look forward to. Whether the president is reelected or replaced, the market has risen 100% of the time, and the average gain on a total return basis has been 15.5%. Obviously, that's not a guarantee. It is certainly more of a comforting statistic, and therefore something to look forward to. But with Wall Street, nothing is ever guaranteed.
No, it's not. But I mean, if history has any value in terms of guidance, I think we're in pretty good shape at the moment.
Yes, guide, not gospel, but we're in pretty good shape. And what it does show is that while there's good upside potential for the S&P 500, let's take a look at the next chart that shows the earnings growth rates, and especially for the mid and the small cap. Take a look at the bottom right-hand numbers in red, and you'll see that right now the S&P 400 is, which are mid-cap stocks, trading at a 15% discount to its own absolute PE ratio over the last 20 years. It's trading at a 30% relative PE discount, so 30% below the average that it normally trades relative to the S&P 500. And those discounts are even greater for the S&P small cap 600, with an absolute discount at almost 20% and a relative discount at 34%. So a lot of good upside potential, we think, is at hand for the mid and small cap arena.
It's interesting that that you say that, because this morning I was looking. I have a predefined group on the RRG page which shows growth and value broken down by size. So small, mid, and large for growth and value. And if you look at that, the rotations right there, it's actually normally what you see is growth and value pretty much rotating in opposite directions. If you look at that graph right now, what you will see is that small cap growth, small cap value, and mid cap growth and mid cap value are actually moving in sync. They're moving in tandem, which is kind of unheard of, actually. They're supposed to be moving in opposite directions. So this is completely underscoring what you're seeing here is the discount for the S&P 400 and the S&P 600 to the large cap. So instead of a growth value rotation, what I think is going on right now is much more of a size rotation, money moving out of large into small and mid cap. And it's completely in line with those discounts, which kind of, I think we could call it some sort of a mean reversion in terms of premium, stock premium.
Absolutely. So the focus is on size, not style at this point.
Yes.
That the thought is that because they're both trading at such a steep discount, that a rising tide will lift both boats.
Yeah, that's right. So yeah, I love it when this is one of the situations where a more fundamental view, or not necessarily completely technical, is aligning with what, in my case, an RRG is showing, and that gives you a pretty good comfort level, confidence in that you're actually on the right track with your analysis.
Right. Now, the next slide is the one we frequently have people ask at the beginning of a year. Should I buy last year's winners or last year's losers? And I like to say that the right answer to most financial questions is that depends. So it really depends on what kind of year are we coming out of. Because in 2022, the S&P was down 19.4%. And what history tells us is that after a down year, you want to rotate from first to worst, meaning move out of those defensive areas like staples, healthcare, utilities, and also energy last year, and toward those sectors that were beaten up the most, in particular, communication services, consumer discretionary and technology, because they will be the outperformers since they have such great upside potential. So the thought is, well, what if you ended up rotating? If you had a good year, you let your winners ride. If you had a down year, you go from first to worst. And the two shading lines are, if you picked either the top or the bottom sectors by rotating. So since 2023 was an up year, you would want to stick with the three strongest sectors. On average, you got 11.9% on a calendar year basis versus 9.8 for the S&P on all years. Instead of the market being up in 73% of the year since the early 1990s, you were up 82% of the time with this strategy. And this strategy beat the market 70% of the time. Not a guarantee, obviously, but an encouraging stat. Taking it a little bit further down into digging a little bit deeper, there are 120 some odd industries in the S&P 500. So instead of looking at sectors, look at sub-industries. And if you pick the top 10 following an up year and you pick the bottom 10 following a down year, what you got was an 18% average return. So at least an 800 basis point average outperformance. You rose 76% of the time and you beat the market 73% of the time. So basically rotating, let the market take you where it wants to go in a sense. And following a down year, you want to gravitate toward those that were beaten up. Following a good year, you want to let your winners ride.
Yeah, that's some valuable insights and some really nice numbers. I mean, these are statistics that I'd be happy to put into a portfolio. I mean, of course, there's never a guarantee, but it's not getting much better than this, if you ask me. I mean, if you get these type of stats, I think it tells you something.
Yeah, and for 2024, you could say, well, gee, how do you get much better than tech, communication services, consumer discretionary? Well, I think what you do is you move down into, let's say, the second tier of stocks within those sub-industries. So instead of sticking with the highest flyers, the Magnificent Seven, if you will, gravitate toward one level below. Instead of NVIDIA, maybe you're looking at Broadcom or you're looking at other semiconductor stocks. But if you go to the next slide, I do show what are the three best performing sectors and also the 10 best performing sub-industries. And so application software, autos, construction and engineering, etc. These on the right-hand side are the 10 sub-industries that were the best performers year to date through December 8th. And then we have some company names that have the highest CFRA stars ranking. And if there's a tie, the tie goes to the company with the highest target price differential. A lot of these are the names that did do exceptionally well in 2023. So if you're looking for outperformers in 2024, you might either stick with these or look to the second tier companies within these sub-industries that might not have moved as much as the top tier companies.
Yeah, and that also ties in very well with the discussion that we had before on the market moving into small caps and mid caps. Like that's the second tier out of that large cap stock. So we see it on the larger scale with the big size or style, if you call it, from large cap into mid and small caps, going into the industries and the sub-industries. And maybe I need to explain for our audience here that what Sam is talking about is the GICS classification structure. So we usually use the 11 sectors. That's the highest level in the GICS classification sector. But underneath, every sector is subdivided into industry groups. I think there's 24, 25 of them. And then every industry group, again, is subdivided into industries. And there is a ton more. And then you can go to the fourth tier, which is the sub-industries. And that's what Sam is talking about on the previous slide. So there's 160 sub-industries in the S&P, not necessarily in the S&P 500, because some of them are so small that they are not making it into the S&P 500. The good news is that here at StockCharts, we have just put up a relationship with S&P Global to get all the GICS codes. And we're in the process of uploading all these indices to our system. So within, hopefully, the next few months, we will be able to show that complete breakdown of sectors and assign every stock to its proper GICS classification, which will help greatly in slicing and dicing that big universe of stocks and doing the work that you're doing right here.
And also, it's good to know that while everyone knows that there are sector-level ETFs, there are at least 20 industry-level ETFs offered by iShares and State Street or the sector spiders. So there are a lot of ETFs that you can use rather than focusing on individual stocks.
Yeah, and what it means for our audience as investors is that they can get a little bit more granular than just buying XLK or XLY or XLV. You can go to the next tier, which is part of XLK, part of XLV, part of whatever the sector is. So great addition right there. Yeah, so I think we're kind of done here with this analysis, and that's great to do. What just dawned on me, Sam, is the first time that we met was actually not on a street corner. It was in a building somewhere in Lower Manhattan at a CMT presentation that I did. I was invited to speak for at that time it was still called the MTA, and Tyler Wood, at that time director of the MTA, came to me and said, "Julius, I need to introduce you to Sam Stovall." And so that's where we met, and he explained and you admitted that, well, you tell why you were there and what happened before, what needed to happen before you could go in, because they wouldn't let you in.
That's right. Well, what I had to do was to pay a full year membership to the MTA in order to come in and listen to you speak. And I thought you were worth it. And so that's what I did. And, always being interested in technical analysis. Prices lead fundamentals, and that's why I believe that the market had bottomed back in October of 22, while we were working our way higher, et cetera, and why to then explain to our analysts why they should not ignore the fact that their groups are doing so well, even though the fundamentals might not carry that out, to say that that's coming. The fundamentals will follow the price action.
And well, I remember that saying, markets are connected to fundamentals, but only by a mile-long rubber band. And that's like probably right up your alley in the way you look at things.
And that's not a stretch.
No, it's not a stretch. Sam, I wish we could do this much longer. Thank you so much for being my guest. And I'm sure our paths will cross in real life anytime. I'll be down in New York. I'll let you know. Again, thanks for being here, and let's stay in touch.
Absolutely, and happy 200th anniversary.
Thank you so much. And that wraps up the 200th episode of Sector Spotlight. Thank you for watching. I hope you enjoyed the show. I sure did. And thanks again, Sam Stovall, for being my guest. I'm looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.